you have some economic charts I wanted to share with you, just to give you some insight. And for everyone on Zoom, were you able to view the reports okay? Did they come through the email all right? Okay. I thought I'd start off on page 2. There's a chart that shows Federal Reserve activity. That's where we'll start on page 2. So there are no shortage of events with the stock markets this year and bond markets. A lot of events driving volatility in both directions this year, mostly on the downside as far as valuations go. Obviously, we've seen the highest inflation in 40 years. Last Friday's 8.6% print on the consumer price index, urban. The inflation continues to move higher. There's a war going on, Ukraine, Russia. The Federal Reserve here continues to raise rates. They basically took rates and moved them up by 75 basis points this week. So they continue to move in that direction. We've had an incredible run with the stock market. Broad markets averaged 15-16% a year. Now we're at a point where we're seeing significant moderation in asset values, and expect volatility to persist through summer months. Traditionally, when you look at July, August, September, they tend to be relatively weak months in the market anyway. Plus, you tend to have a downward trend in volume, so you don't have a significant level of activity in the markets. Morning.
Good morning. Morning. Watch that way. John.
Oh yeah. Good to see you. Peter.
Peter, nice to meet you.
Nice to meet you.
Amanda.
Hi, man.
Hi there.
Hello, Mr. Hank. Hello, Mr. Brown. Mr. Wright.
And we're actually on page 2 of this report, kind of walking through economic activity.
Yes, please.
Yeah. And the silver lining is with asset prices being cheaper today than they were a year ago, the future of the outlook of the future looks a little encouraging. It does create opportunities today. So although asset prices are cheaper in both the stock market and the bond market, we're below trend, if you will, with the stock market. So there is an opportunity to move higher from here. I think the market at this point really wants to see inflation move down. They want to see interest rates they want to see the 10-year be lower than 3.3%. So you're really going to need one of those things to happen for the market to respond in a positive manner. So as you look at recession, that word's being thrown around quite a bit these days. Are we in one? Are we going into one? And the interesting thing about recession, we really haven't seen a significant breakdown in economic fundamentals. When you look at a lot of the economic indicators out there, they have not broken down. In addition, when you look at the major sectors that tend to break down preceding major recessions, you're not seeing that. Energy is one, materials another, industrial sectors is another. So those 3 sectors right there are not the laggards in the market. They're more of the consumer discretionary sectors. The retail sector has been hit quite a bit. So just kind of wanted you to see here, what the Federal Reserve is doing, coupled with some of the economic activity. But the key here is, as you look at page 3, as we talked about before the meeting, having a long-term view in this with long-term money continues to make sense. You got to have a wide lens here as we continue to view this, as we try to stream through the volatility. This chart on page 3 shows you the broad market and how its performance has been for the past 30 years. And you can see the intra-year declines in red. Every year we've had some sort of sell-off in the market for many reasons, but you can see the performance there at the end of the year is in blue. So just to put this in perspective, there's usually catalysts that causes the market to fall. But as you look at history, 3/4 of the time, the market's positive. It's positive more than it's negative. So it reinforces the idea that we really need to continue to stay grounded in our investment philosophy, stay invested Timing the market never works, even in an environment like this where it doesn't feel good. Now is really the time to stay grounded and stay invested. Any questions about the first two charts before I jump into the portfolio?
This year to date is till probably like beginning of this month. So it's first 5 months.
That's right. This is as of May 13th.
Okay.
So
first 4.5-ish.
But that's correct. Yeah, this is about middle of May. So about 5 months in. This is really overstating the drawdown in the markets. It's more like 20% at this point. But that 18.1% represents the market from its highest point to its lowest point year to date. Yeah, which is about 5 months in. Does it help, Brian?
Yeah. And I guess the one thing that may not look that way by the time we get to the end of the year is this intra-year decline relative to the annual total return are basically equivalent in this year-to-date one, whereas it's almost never equivalent in any of the other years. Once you get a full year under for analysis, it's probably going to look very similar to the others, I would expect, right?
Exactly. Yeah, and we still have a number of months to go.
Yeah.
But you're right.
Just the timing of it.
The timing. Yeah. These rarely look the same.
Yep.
And who knows? I mean, we read a lot of analyst reports and crunching numbers and looking at the market. I mean, if you look at the Dow today, it's at it's a little shy of 30,000. You look at the S&P, we're at 3666, and a lot of targets that I've seen in the broad market this year. Not that we can time it perfectly, but a lot of end of year targets are about 6 to 7% higher than here, and that would be around 3,900. So that's from this point. So if things were to hold true that way, then you're going to see that disconnect between the red dot and the blue dot. Yeah. If you look at the portfolio on page 4, we put this together as of yesterday for you. So you can see the breakdown on the left. There's the asset allocation. You've got about 39% stocks for growth. We've got about 52% fixed income, and we've got about a 9% cash position there. Matt Weaver's, he was able to take some stocks off the table as we went into 2022, which is good for the town of Mount Desert. So you haven't had both feet all in the stock market, which is good coming into the year. We actually took some profit on the S&P 500, had a really nice gain last year. So we were able to take some off the table, reinvest it into fixed income. And you got a little bit of cash there for one, potential disbursements, number two, opportunities that are available out there in the marketplace in both the stock market and the bond market. We do rebalance our portfolio. So as opposed to trying to time and game the markets, if you will, we do trim when we perceive markets to be expensive, and then we buy into areas of the market that are out of favor when we can. So we've done that a little bit this year early on. We're now finding more opportunities within fixed income. That's the silver lining. As rates come up, you're finding more opportunities to capitalize on in the bond market. But there's the total value there, about 8.3 million. You can see the equity diversity there in the middle. So we continue to be committed to this idea that we need to stay diverse. That always seems to be the winner through any kind of market environment. We want to try to reduce loss if we can on the downside, but obviously have the town of Mount Desert participate on the upside when it does happen. You can see the exposure that you have to risk. You've got about 27% S&P 500, which makes up about 45% of your stock market exposure there in the US. You do have some mid cap and Russell 2000 small company names there. Traditionally, these tend to lead out of recovery when the market starts to perform better. Small companies start to perform well. Interestingly enough, if you look at the developed markets exposure and the emerging markets exposure, these are all low cost funds in which you're invested. These are leading the pack this year. These are the only two investments that are shy of a bear market, if you will. Everything else is just about 20% or more as far as losses. So We do change this adjustment. We do adjust this dial from time to time.
And I want to be clear that the town does not own individual stocks. We're strictly in funds.
Correct.
Thank you.
And we-
Carry on. I want to make sure, as we're on this, I want to make sure that I think you've done well.
Absolutely. And this is common with, we manage about 40 municipalities. And it's very common for us to have, actually, I can't think of one that we hold any individual stock exposure. We like to reduce risk as much as we can, spread the assets out, instead of investing in one company where you could very well see, company specific risk. We don't want to put we don't put towns in that sort of risk.
I have a question on this. Our our ETFs and mutual funds, it doesn't seem that they're excluded in our investment policy. It only treasuries are excluded, the 5% holding. Is that, how do other municipalities deal with that?
Great question.
We've seen it done a number of different ways. So you mean as far as JB, like whether they can hold
Like
individual
our
stocks?
investment policy says no more than 5% can be in any single issuance.
Issuance
End of the
company.
year.
And so like holding an ETF with more than 5%, is that a disqualifier or? Because I know that's your philosophy is using mutual funds and ETFs.
Yeah.
And do we need to revise our investment policy to accommodate that? Because it excludes,
Right.
you can hold treasuries
So treasuries, yeah.
up to any limit, but not, it doesn't specify anything about E ETFs.
Yeah, and that's the difference. So of the investment policy statements that I have reviewed over time, I've reviewed a lot of them, and most of them are all focused on individual issues.
Right,
So that they don't point to mutual funds, like the S&P 500, you've got 500 holdings. So
Yep.
You're not likely to see one holding in there be more than, Your
so by
5%.
inference, the ETFs and mutual funds are, even though it's a single Vanguard fund,
Yeah.
it's not considered a single fund because it's diversified into 500 individual holdings.
right.
But should our investment policy be more specific in that regard? Have you ever seen, do other municipalities address this issue?
I've seen a few that say X percent should be in a fund. So it really depends on the municipality. I've seen it
Okay.
done a bunch of different ways. I can send you a few, like
What is it?
nonprofit ones that we've got 85 nonprofits.
Right,
I can send you some of those that I've seen that have that language in there. And obviously we have to abide by that. We only have 3 or 4 that have that language in there that say, okay, we can only have X percent in Vanguard or Dodge and Cox or whatever the fund is.
To avoid
That's a good point.
being too heavy in a single fund.
Exactly. You're
Correct.
one issuer.
Right.
Yeah, I have seen that before, but if that's something you'd like me to send to the group,
Well,
I'm happy to.
I think the historical interpretation has been that we don't see these funds as that same language of an issuance. We're looking at the fact that it's dispersed amongst 500 different holdings as being compliant with the intent and the goal to not have too much assets in one holding.
but perhaps ETFs are slightly different than ETFs are formulaic. Whereas
Right.
mutual funds allow a little more discretion.
I mean, we could, there's definitely a way that you could craft out some language that would just say, hey, investment in funds that spread out
Diversified funds.
the money to lots of different holdings are consistent with the intent described above. Something like that.
And
This is a topic later in our agenda.
Right. We have a policy.
Okay,
We have
that's
to
in
do
there.
some of our policy work today. So when you mention other nonprofits, this is my chance to ask the magic question that no big tobacco and what's the position and oil, because I know that's often, parts of nonprofits, request that, and I've done that in other places for the same reason.
It happens quite a bit. Depends on the entity and what's important to them. Some folks do have that. I want to avoid all sin stocks. And the tough part too is when you're looking at an index strategy, it's hard to avoid it. So in some cases, we do build in some actively managed funds that are more ESG focused, environment, social, corporate governance, and the active management by default, they're avoiding those for us. So we do that quite a bit. Vanguard has a few of those that we
Right.
utilize. Calibert's another one. Really depends on the nonprofit. We've seen all kinds that have different goals. Impact investing is another goal.
So is that a background, is that something we need to check that the town is invested in big tobacco?
It's really up to the town.
Yeah.
So as that might come up later and
Right.
when we have our conversation. Perfect.
I-
Why don't you carry on?
Well, I did look at the climate declaration. that
Correct.
The town did, and there's nothing about divesting from fossil fuels within that declaration, but I could find.
Right.
And I was thinking along the same lines, and if we want to talk about that later, we can do that.
That'll
But I
be our
think
own
there's-
personal thing.
Yeah.
And then we'll go back to you.
Exactly. Yeah. And we can customize this any way you like. So that's the beauty of what we do. So that's something that's important.
Thank you for that.
Okay.
Well, I think that the investment policy also says that we're supposed to be meeting quarterly, so we could potentially bring this back in October with proposed changes after these discussions.
Right.
Absolutely. Before I leave page 4, I just wanted to show you the fixed income component of the town of Mount Desert's portfolio. So this has been a very unique cornerstone of the market this year. Obviously, with rates coming up, current bond prices have come down a little bit. But the silver lining again is there are more opportunities today in fixed income than there were even 5 months ago. Right now, your portfolio is yielding just about 2.7% in bonds. And as you look at where rates have been over the past 5 months, they basically have doubled. So if you look at a 10-year treasury bond, they've almost doubled from where they were just a few months ago. So as you look at your breakdown, you're about 26% of your bonds are in individual issues. So you do have a combination of very high grade CDs, high grade corporate bonds that align with your investment policy statement. So you're never going to see a bond in here that's below investment grade or junk. We don't do that. We don't believe investing in junk bonds for clients. And the rest, we've complemented these with bond funds to provide the town with a higher level of diversification. Over time, as rates continue to climb, it's our intent to trim out of some of these bond funds and to move into individual issues. Individual issues are nice because if rates continue to climb, you don't have to necessarily worry about price drop. We just care about whether you're going to continue to receive the cash flow and obviously your face value at the end of the term. So the more opportunities continue to roll out in the market as rates come up. But right now you've got a nice blend of diversified exposure and the yields continue to come up with some of the bond funds that you hold too. So, and one thing I'll highlight here is the short-term inflation bond. You've got about 600,000 there. This was up last year about 5 to 6%. So these are called tips, and they tend to pay you. They pay the town as inflation comes up. So these have really paid off. Anyone that holds a tip, Treasury inflated protected security, really these have paid off for you, especially in an 8.6% consumer price index environment. So a nice overall nice blend there. Any questions about asset allocation, equities, fixed income before I show you page 5?
Quick question about CDs. It looks like none of the there's a different report that shows the breakdown of the fixed income, and looks like we're compliant with or we're under the federal DIC $250,000 cap. Is that a policy per bank that we invest in for CDs?
Yes.
Okay.
Yeah.
I just want to make sure.
Yeah,
And
we
is that
do.
in our investment policy, or is that a part of you guys just looking out for us?
That's part of us.
Okay.
I didn't see that listed in your IPS, but that's generally how we invest in CDs for everyone.
Yeah.
Just make sure you're below those limits, and that's 250.
Okay.
And I've got, for those of you who want to see the breakdown, I've got it here.
Mhm.
If you need a break, you might not see it there, but if you need to
One of
see
the other ones.
yeah, one of the other ones.
Are there any
Tell me
areas where we have credit risk? I mean, aside from obviously just the nature of investments, but in the same way that having $255,000 in a CD would be a credit risk.
So you do have credit risk in the sense that you're investing in corporate bonds, but per your investment policy, we're invested in A or higher as far as quality goes.
And if
So-
anything dips below BBB, you'll sell immediately.
We do, yeah, we evaluate it as an investment committee, and then we look to sell. Yeah, so we're always monitoring our fixed income. But we're buying high quality enough where, very rarely are we seeing a downgrade, and if we do, we just dispose of it quickly.
Oh, just so I can keep capture this correctly, just the cap that you're talking about, the 250K cap, can you give me just a quick name for how you want that captured in the notes of like
That's federal
Federal.
deposit insurance,
FDIC?
Yeah.
FDIC
yeah.
limit.
Yeah.
So banks do this all the time where they parcel it out, 250,000 at a whack to different banks.
Yeah,
The
okay,
bank
sure.
doesn't pay up. It's
Yeah,
all-
and it
it's all
wasn't-
back- it's all back to 208.
It's not
Yeah.
necessarily in our policy, but it is a part of their.
Internal guideline for us.
And
Yeah.
it wouldn't hurt to put it in the policy.
Sure.
Absolutely.
All of our, all of our assets that would be subject to credit risk have either this relationship where it's being monitored, or like with our operating account, with sweep account that it is all collateralized and spread out in accordance with FDIC insurance.
And that just prevents or helps you make you whole, if you will. Something happens to, like, let's say you do have a bank failure, a CD failure, then you're compensated up to 250,000, basically.
Right.
That's all.
Yeah, I just want to make sure I capture it well for the notes that the essence of what the question was. So,
Makes sense.
So on those CDs, is the policy that the income is just paid into the fund, or is it capitalized to the CD?
It's paid out to the fund. Yeah, so it ends up being in cash, and that's how the dividends and interest, how those are distributed, end up funneling down to our cash bucket. But while we're on that topic, do you have any other expenses that you expect to come out here in the near term?
Yeah.
Any addition to anything different?
You're gonna wanna draw 2 million.
Well, this is,
2 million, right?
that's out of a different bucket.
Oh, it is.
This is in the money market, which is actually held with First National Bank, which is not being discussed today. as I
Oh,
understand.
okay.
That's right.
I was,
Yeah.
Yeah.
I thought that was part of our.
And this is, and that does, since it was brought up, quick question on that. I noticed that our money market and our sweep accounts are basically identical in terms of rates. Do you expect that money market's gonna outperform the sweep rates as we see the rates increase?
They're gonna be close.
Okay.
Since basically this is a sweep product through the bank, that they do move up in tandem.
Mhm.
Sometimes this is a little bit faster to react, but they're gonna be relatively close.
Because I was just trying to understand why we made the decision in the past to have the money market account over the sweep account if we were experiencing very similar. I understand a portion of it's related to the $500,000 requirement in the short-term reserve section of the investment policy.
Yeah.
But above and beyond that, the sweep account, is easier to access for cash flow operational purposes. And if the rates are comparable, it seems, I guess I didn't understand why we made that decision in the past, and I don't know, Amanda, if you have historical context. on that.
Yeah, I was trying to remember why Kathy at the time. I don't know if it was internal, something internal, but she had approached me about moving that, so,
Okay.
yeah.
Well, as part of that, do we want to, in our review, is lower the amount of cash these folks hold?
Is that a specified number?
Yeah, 500,000.
Well, that's the short term, that's from the bucket that I was talking about,
Oh.
the money market account. I believe
Oh.
that's how that's been interpreted. That well, you tell me, are you taking the $500,000 to mean the cash balance within the $9 million investment fund?
Yes,
Okay,
yes,
okay.
that's
So,
what I was.
Clarify that.
Yeah, because I knew we have two main sides with First National. We've got what you're discussing today, the $9 million portfolio, and then there's a $5.5 million money market with the bank side. And because they were both held by First, and I think originally Amanda, you were saying that the $5.5 million was under the wealth management.
It was in a
Umbrella.
separate custody account
Right.
with us, yes,
Yeah.
yeah.
And so I was thinking that that was set up to satisfy the short-term reserve portion of the investment policy, and it's just grown to be substantially more than the $500,000 requirement. But so maybe, yeah, I guess a little bit. It sounds like it's just an operational fund then, if the $500,000 short-term reserve has been interpreted as being the cash held by the wealth management portion.
Right, and here, so right now we have a little bit more cash anyway. You've got just about 230,000 more than what's in
Right.
page 3.
730.
Yeah, 730. So
Again, this should be clarified for these guys,
Yeah.
because in an up market, we would do well to hold less cash.
right, yeah, and this too, we're holding a little bit more cash here anyway, just because of where we are
Right,
in the markets. Usually this would be, as you said, JB, this would be down in a normal environment. This would be down a lot more.
right.
Well,
But if you're
cash piece.
operating on that $500,000 threshold, that may not be, we might want to
Right.
reword that so it's clear for.
Sure. And so in terms of expenses, just so, and this is broken down in that cash analysis. Where the wealth management portion, the $8.59 million figure that we're talking about is broken between general fund investments assigned as town reserves and then assigned as marina reserves. And so when reserve funded expenses are brought before the board and approved, what happens is the general fund operating account will cut the check, and then there's a interfund receivable and liability, and the reserve fund currently owes the general fund money for those transactions that were paid on their behalf. So that's where the expenses come in, is that on periodic basis, assets are liquidated from the wealth management funds that we're talking about to reimburse the general fund for expenses paid on behalf of the reserve account.
So the 5.5 million in the other bucket, where that's just, that's an operating sub account.
Yeah, that's accounted for in the general fund as investments. And I agree with you that we could make the investment policy a little bit clearer about how those two are handled, because obviously, Peter and I looking at it, read it a little bit differently. I assumed that it applied to the money market, whereas it's historically, I guess, been understood that that's the cash balance within the wealth management fund.
That's right. Happy to work with you on this, on language, if you like. Any other questions before I just show you page 5? I wanted to show you just the breakdown of the fixed income here on page 5. Kind of an interesting view for you, something different. Just wanted to show you just the maturities that are coming up here within fixed income. We've got just about 600,000 coming due over the next couple of years. So the timing is good for these, as we can look to reinvest at higher rates. But I wanted you to see what our game plan was for the bond funds. That's the unknown figure here on the right. So the idea here is to trim these down and buy into, at this point, they'd be relatively short. Right now we've got a relatively flat yield curve where it doesn't really make sense to invest long term. So we've been investing a lot of monies in the shorter term debt instruments recently, just to capitalize on where rates have been. And a lot of the short-term instruments are actually are looking more attractive today than they've been in a while. So I think the timing for this is good, but just want to give you a game plan is what Matt's looking to do here over the next year. But just an interesting breakdown for you. And then page 6, I wanted to give you an idea as far as performance through the end of May. And I believe we sent you performance through December too, so I believe that was going to be something that you'd like to cover too. But this shows you performance through the end of May. And I just wanted you to see, so the green bar is the town of Mount Desert. and the blue bar is a benchmark that best represents the portfolio. So as you can see, fiscal year to date through May 31st, no surprises that everything's down this year. We're down about 8%, a little better than the benchmark, which is down 8.68. But as you look at this longer term, 3-5 years, we continue to meet your goals that you have, even with a downturn, taking this from a very, very low spot. If you were to look at the average, it's your goal to achieve a total return that's going to be in line with the GDP price deflator over an average 5-year time frame, and you're doing that over a 3 and 5 year time span. 5 years, you're averaging just about 4.6% longer term. Taken from November 30th of 15, you're up just about 5.39%. So you continue to do well without having both feet in risk, if you will, in the stock market. So having a plan like this, having it diversified, having it rebalanced has worked out for the town over time. Even through the dips, it's not fun, but we're going to get through it.
And our return is gross of fees,
Correct.
which is 75 basis points.
It's less than that. The
Oh,
fee
it
is
is.
less than 75. Yeah,
60% discount.
Okay.
Yeah.
40 for 60 bits. Yeah.
40%. Yeah. So our standard fee for institutions is 75, but the town's being discounted 40% off of
Yeah,
that.
40, I believe.
Oh,
Yeah.
nice, okay.
Based on our holding.
Right,
Right,
right.
as a higher holding, that's when you get
Right.
the discount, if I'm not mistaken, right?
Correct. Yeah, as far as asset value, correct.
Is that something that should be reported kind of more regular? Because I didn't know that. How would that be reported to us? Doesn't
What
show it.
particular?
What the fee, just, what we're actually paying in fees when you're assessing a graph like this, is to have in your head what what we're losing to fees.
Sure.
It's not bad, but again, I didn't know that we've been discounted from the 75.
I could follow up with the committee. I track the fees when I do the investment reconciliations.
Okay,
And I could compile that and get you a 2021 figure and also a year-to-date figure.
I'm just asking,
Although I'm sure you
can
guys have
you put it on our statements? You charge us the fees. Is there a way to insert what the actual fee
Discount.
amount is?
I can show you well, actually, the statements that I sent, they do show fees listed very clearly. I don't know if it shows year-to-date fees.
No,
It
does.
shows the dollar amount of fees that
Yeah.
Oh, you're talking
that
about
come
percentage.
out.
Right.
Yeah,
And basis points, sorry.
they
Right,
show for the period, like Mays will show for the period, and then they show year to date. They
Right.
won't show the percentage, but
Right.
it'll break it down per dollar amount. But I can send the group the actual number too.
because
That's
when
easier.
you're looking, as I say, when you're looking at a graph like this, it's helpful to have in your head what the net of fees is.
Absolutely, I agree.
And your fees are paid quarterly like most institutions.
Monthly.
Our fees are
Monthly.
deducted monthly.
Okay.
Yep, not the whole fee at once, but just that divided by 12 basically, and it comes out.
Understand.
And it comes out the second week of each month. That's when the
Right.
fees actually deducted monthly basis. Yeah, so that way you're not gonna have a huge chunk come out. Piecemeal. So that's the report I put together for the group. Try to be brief for you.
Mhm.
What other questions does the group have about this report? And anything there that Mandy and I can dive into there?
Oh, in your economic overlook, what's your take on labor markets and wage inflation?
Yeah, it's been an interesting view with wage inflation, because we really haven't seen a significant amount of wage pressure going up as far as wages go. We really have we've seen a significant increase in price inflation, not necessarily the services side inflation. So and that's one reason why early on why the Fed didn't want to hike rates quickly, was because the wage pressure really wasn't there, and we're really not seeing it. Really haven't seen that come to fruition now, but the labor market continues to be extremely strong, and that's one reason why the argument against having a recession is there for this year, because that's one of the very strongest parts of the market is the labor market. So, but yeah, the wage pressure, we don't see that becoming an issue, obviously, especially now with rates on the climb. that's less of an issue today than it was a few months ago.
Pressure off the gas pedal.
Yeah, exactly. Yeah, yeah, and that's the key. And I know, inflation with gas prices the way they are. I know it's tough to think of inflation prices coming down, but the expectation is that if you look at the futures markets and what the traders are saying about where inflation will be end of the year, a lot of those folks are saying that inflation very well could be 4.5% to 5%, looking at the consumer price index. But I know a lot of that has to do with how much demand can be composed, and we're starting to see that. If you look at consumer goods like TVs, you look at phones, some of the prices are starting to recede a little bit. So, but it'll take a while. I know it's taking a little longer than what participants thought, going into the first and beginning of second quarter.
I think the market demands are much more complicated than even the experts think, from all, and between manufacturing, supply, inflated oil prices and food prices,
Yeah.
based on all those things.
Right.
It really, I don't think anyone has the crystal ball on that one.
Right.
Yeah.
So whoever could scream loudest, who people listen, then the market, lives on fear.
Yeah, and it's a tough balance for the Fed too, because they can only control that demand side. But they can't control what's happening in Ukraine. They can't control supply, and that's an issue that the Fed has to contend with. They can only do so much. But yeah, that's a good point. It's tough to determine. The Fed's job is very tough with
And they have
with
one
inflation.
tool.
Yeah, they've got one tool. Yeah, and it's not like how it was in 2001, 2008. I mean, we're trying to get to a point where the Fed can drop rates again at some point, but that'll be a long time. In other recessions, they had the ability to drop rates, and now they don't necessarily have that. You do have some other reports in there. Can I answer any questions about those at all? And let me know if you'd like me to send some write-ups on investment policies on some of the topics we discussed. I'm happy to do it. Just on some sample language. Happy to do it for you.
Maybe we'll do an initial revision and certainly send it to you for your comments.
Okay,
I mean,
sounds good.
that works best for you to eyeball it.
Sounds good. And Matt will be back in the office sometime next week. So it's nice to be able to come over here and cover a little bit. So it's nice to see you all.
Mhm.
Yeah, I think on the amendment portion, I think the big thing is we want to add language that solidifies that we're able to invest in the mutual funds and things that diversify, and not treat them as one holding. And we want to do it in a way that doesn't, we don't want to have language in there that handicaps, your vision and what you guys have already been doing. And I think that's the biggest risk we would run, is if we try to put something down and then we miss a category or something like that, and you go, oh man, that would have been a great investment, but their policy just said we can't do it now.
Right, you're too
Right.
restrictive. Yeah, absolutely. I'm happy to give you some guidance on that if that's what the committee.
Because some of those mutual funds do have a small component of alternatives that are typically barred in nonprofit and municipal. So, yeah, you're right. There's fine points that we don't want to mess up.
Exactly. Yeah, and each mutual fund is going to be different too, depending on passive, active, what the makeup is. But I'll definitely help you with the language there if you'd like.
Great. Any other questions or comments?
I do, because I'll go back to, again, the town has a climate action plan right now, and we have a climate emergency. Do you handle any environmental groups as any of your nonprofits?
I can't think of any that we handle. Can you think of any that we, I don't, of the 85 nonprofits, we don't have any of those that I know of.
Many, I can speak for two nonprofits that are actively discussing this. And the nub is that the returns on ESG funds are significantly lower.
Yeah.
We know that.
Yeah.
That's why I wanted to ask,
Right.
you know,
Right.
the reason was, I want to know what kind of performance data you had or, you know, experience and, you know, I can't do everything, you know,
Yeah.
as far as, you know, knowing what the future is of those type of things, because I think that can change. I think
Right.
I think as the markets increase and, you know, it's pretty maxed out right now. It'd be
Yeah.
interested to see how it plays out in the future.
Absolutely. Yeah. I mean, we do have a few nonprofits that want to be in this whole idea of ESG, or they want to avoid sin stocks. We do have a few of those, a handful. And we've built in a Vanguard socially responsible, socially conscious fund that fund's got like 0.2% energy. But as you said, it's significantly underperforming the broad market, just because the broad market has an energy sector.
Mhm.
And when you've got a barrel of oil where it is, you're not going to participate in that, unfortunately. So, you know, obviously we're still prudent in how we invest with these folks, but I try to get that out there that, look, in a good energy environment where you've got constrained supply, you've got heightened demand, you need to understand that you may underperform an ordinary index, or perhaps even another active fund that's going to invest the same way.
One moderating influence I see in the future is that companies being forced to account for climate exposure.
Hmm.
Assets going underwater, literally.
Literally, rise in sea level,
Right.
where he's going.
Yeah.
Right. And I think that will have impact on valuations. When those liabilities start showing up on balance sheets, those stocks are going to become less attractive.
Yeah, the definition seems to be changing too as
I know.
we go along, with the whole idea of impact investing, what that means to the investor. So everyone seems to have a different definition, and I've seen some investment policies that say, all right, I need to exclude this company, this company, this company. You can invest in whatever else you want.
Mhm.
So I can show you that too if you want. But yeah, there are a lot of those.
So it'd be like, it's simple, it's what he's saying there, they're saying, we can't own Archer Daniels Midland Company because they are, you know, or Monsanto because of GMOs.
Right.
That's the kind of thing he's probably seeing.
Right.
Exactly.
How does a municipality, does it operate under the same fiduciary rules as a nonprofit? Like the board of a nonprofit has this responsibility to care for the assets of the organization.
Mhm.
And that's where you get into this. So if we lose 1% of our return, is that being stewards of in an endowment fund? How does that impact things?
In general, the rule is that we're to invest the funds as a reasonable person would invest their funds. And we, you know, so we're not putting it all into Bitcoin. We're putting it in.
Why not?
We're putting it into things that can be reasonably expected to, you know, with a long-term view in accordance with our investment policy, produce income and growth for the town in the future. And, you know, the fact that markets go up and down, it does not mean that we're not meeting our fiduciary responsibility.
But this difference of if we told them to pursue an ESG strategy and we gave up a point,
Yeah.
100 basis points, how does that affect our legal position?
Sure. I think that I think you might, and I'll let you address it, but I think you might have people that would make that argument, say, you know, that a portion of this this is my money. Why did you vote to reduce the return on it? I don't think it's an untenable position, and I think it would not be something that, you know, a claimant would. I'd be very surprised if they won on a case on that you didn't meet your fiduciary responsibility when you know, at the end of the day. I think that's a reasonable political decision, but you could see backlash if we're underperforming the rest of the market because of a decision to stay away from assets that we know probably do well because of political concerns.
And the Maine statutes also say, in terms of municipal investing for an investment manager, is to consider all available, considering your surroundings as you're putting a portfolio together. So, you know, what's important to the town, what are they trying to achieve, obviously with diversity, but also considering inflation. You need to build a portfolio. If you do have stock exposure, you need to build a portfolio that's going to help you fight inflation, and having energy exposure historically has been a means of doing that, especially in an environment like this. It's used as a hedge against higher energy prices. So it is a difficult argument, but that's where the main statutes come in. And we have this conversation with municipalities that don't realize that they can invest in equities with their reserve dollars, and we're pointing to the main statutes and saying, well, look, based on the investment manager needs to invest prudently based on all available factors.
And it doesn't mitigate, the political concerns about addressing climate change or anything. This is not the only avenue to do it. I'm not saying that anyone's saying it is, but we can, it's a very reasonable approach to say, we're going to go after the best reasonable returns we can, while also, using those returns to invest in renewable energy and to address the climate concerns that we see.
Can you generate charts with multiple benchmarks?
I can, yep, I can. It's done with that December 31st report. It's got everything in it.
Yeah.
I can customize that to what you need.
Well, I'm just saying, what we're using as a benchmark, I think is really, aligns with our portfolio. So I think it's a great, but if we were to move in a different direction to maintain that one, but then create a second benchmark, an ESG focused benchmark to show both side by side. I mean, some people might not have seen that difference, but I think it's important to see it.
Yeah, and that feels like a really good idea to do, given that we may be contemplating moving in that direction. We ought to know something about what that looks like,
Right.
before we would try it.
And here's another
Make a
thought,
move like
and
that.
something we may want to consider as a group, instead of going 100%, do we do like the classic toe dip? We, do a 30% to see how it performs again, so we can actually have that number, see the reflection, and, we can then reassess, on our next meeting or after a calendar year that, this was a failure, and, for the city. We have citizens on both sides. We have citizens who are going to want to have the most aggressive investment that we can have, and then we're going to have the ones that are going to want the social responsibility investments. And so I think that it's helpful, back to the political argument, so we can always have both sides.
And that's been my way around it too for nonprofits, because you're always going to have both sides of it, and you're going to hear about it. So for some nonprofits, like I'll have our strategy intact that'll hold everything, but then I'll add in that ESG fund or impact fund, whatever it is, just to provide them with some exposure to it. And I'll put on the report so they can see it, and I'll bring some performance, but that's something we can happy to talk about and implement.
Right. So, let's say we did like a 25%, or, back to your allocation, let's say we picked like 20% or 25 to see how an ESG did. And you come back and tell us it's down 32% for the year. That's going to make us sit here at the table and say, maybe this is not for the best interest of the town. How is, we all know that these type of investments are supposed to be very conservative for the right reasons, because it's not our money.
It sounds like a very similar approach to what we've done with the capital improvement plan, in the plan that was approved in the budget at the recent town meeting, where, it's been relayed to us that, in the future, the town would like to see electric vehicle purchases for town fleets. And as of right now, that's a hard number to estimate what that's going to be in the future. And so we have kind of hedged, and we have amounts that are estimating future costs of being able to do that, to subsidize what would be put up in the future to meet those goals. But it's a small step without solidifying anything. And it sounds like a 25% approach or something like that would be a way to say that, hey, we're trying to meet these concerns and trying to move in that direction for people that are concerned about it, without, as you said, signing up for what could be a catastrophic, fiduciary responsibility issue.
And I'm happy to help in a sense. So let us know how things go, and we can easily accommodate the town.
Well, thank you.
Absolutely. Thank you all.
Thank you.
Good to see you.
Good graphs, they're all easy to read.
Thanks. Let's try to make this easy and not hard for you, so happy to do it. Is it raining when you came in?
It was not.
No.
A little foggy.
Even in Seal Harbor where it's really foggy, it's not.
It's kind of dark at Bar Harbor when we laugh.
Right.
Good to see you all. Good to see you, Darrell. Good to see you, Wendy.
Yeah, good to see you. Thanks very much for that great reports.
Yeah, thank you. Take care, everybody.
Thank you.
Weekend.
You do the same. Thanks.
So we'll jump back up to elect officers. I believe I'm the chair. You're the secretary? Or no, you're the.
No.
secretary.
On paper, I'm the secretary. And I think he and I need to change roles here's a couple things. I think Brian was originally from the warrant committee and I was originally a citizen. Brian is now on the school board and no longer on the warrant committee, so I don't know, Sterling, does that sound correct that he and I should, as far as our
Yeah,
representative?
you still have your warrant committee and your citizen member. It'd just be
Right,
the same people
So
switching.
Brian would become the citizen member and I become the warrant committee member if questions.
Okay,
I think as far as the group, it doesn't change anything. It's just, we still have the bodies in the room.
okay,
But just if we want to be technical, if anyone ever asks, I am the representative of the warrant committee and Brian will be the citizen.
okay.
And then we can do our other piece.
And I'm a citizen. Wendy, you're a citizen as well?
She's a BOS member.
Okay. Well, in terms of the heavy lifting of the chair, I'm happy to give it up. If one of you two wants to take it over, I'm happy to stay.
I already chair 2 committees, so I defer.
Okay,
I'm chair of the school committee.
Okay.
So I would,
Are you willing?
I am willing.
Well, I'm willing to serve on your behalf. How's that?
So do we need to have a formal motion and,
You should. You should.
Okay.
try.
You can present the whole slate and then
Okay.
move that.
well, I would propose a slate of Brian as, do you want to stay as secretary?
Do you mind being the secretary?
I don't mind, it's fine.
Because you just took all the notes, right?
Yeah, I did.
That was his plan of coming.
And again, from past experience, I've had Brian as the secretary of the warrant committee. His notes are exceptional. So if Willie, will you be the secretary? It's all, it used to be Darrell would take the notes and it's.
I'm happy to do that.
That's,
So I propose a slate of me as chair and Brian as secretary. Is that all we need?
Isn't that the current slate?
Current slate is Phil, the secretary.
Well, I mean, in
The
terms of
position-
positions.
Just the 2 positions.
Yeah. Oh, yeah, yeah.
So somebody second that?
Second.
Any discussion? Any opposed? We've got a slate. How do we want to approach revising the investment policy? I mean, it's so hard to, where do you start?
Mhm.
Any suggestions?
Well, took a few notes. I can reach out to, sounds like Matt will actually be, Matt and Peter, I can talk to both of them. The big one, I think, is we want to add language that specifically addresses investment in index funds, mutual funds, ETFs, et cetera, to allow for what we're currently doing and just kind of highlight that our interpretation of this policy is that these are diversified funds. We don't consider this to be one giant holding.
Right.
But use language that doesn't handcuff us in a way that we weren't prior.
Right.
Maybe specifically address FDIC insurance so that it's spelled out and we're not relying solely on good management for that. And I can draft language and get them to go over that.
and so that would be, just to back up, so that would be any individual account can't, FDI is limited, it's always been $250,000, even for individuals. So
Right.
Right.
that's just good management.
To have some mechanism that accounts for that. Either it's under FDIC insurance or there's collateralized securities in some. And then I think we probably want to clarify the money market account that's being used as a general operating. And we can talk more about that because right now, and you can see in the cash analysis and also from what Amanda said, and they had every incentive to say that the money market account was superior because we hold the operating account with Bar Harbor Bank and Trust, and they hold the money market account, and then also the wealth management fund that we were talking about. And so the fact that they said, you know, the money market account and our operating sweep account are going to perform basically in tandem, it does call into question, you know, what is the need for having the money market account when the sweep account offers much better cash availability for operating expenses, especially when you're talking about a budget like ours, where we have a very heavy front end budget. There's lots of debt service payments that are due 7/1, for example. And, you know, it may be mid-July or so before tax payments really start rolling in that are meant to cover those fiscal year expenses. And so it might make sense to, at a bare minimum, reevaluate how much we're keeping in the money market and focus some of the money into the operating account that is being invested every night through the sweep mechanism at the same rate, roughly, as keeping it in a different bucket over here with First Bank in the money market account.
Right. It would make your life a little easier, one less account to deal with.
Well, yeah, I mean, it's one less agenda, and I think
Yeah.
Kathy and Wendy could probably speak to this because she's been on the board for a while, but I don't know. I think in the past, Kathy as a signer moved money from the money market account to the operating account for cash flow purposes. The way I interpret the investment policy, I think that would be considered a redistribution of funds because it's going from an investment centered account to an operating account. So that's why I'm taking it before the board. I think that that's in line with the intent. It's not like I'm, you know, for example, we just opened a capital projects operating checking account that houses the most recent bond issuance funds. And the operating account pays for the pay estimates for the construction on behalf of the construction fund, and then money is transferred. And that was the whole intent of it. Whereas if we're parking money in a money market account, it seems like the board has the authority to authorize moving it into an operating account. And I guess the last thing on that is just that if there's no benefit to having it in this other bucket, you know, it might be time to just think about why we are doing it.
Right. Especially if the return's the same.
Right.
Yeah, I mean,
Right.
it sounds like it's a whole complicated step with, you know, a complicated paper trail that you're managing two separate accounts to do the same thing. Or you're moving unless they really enjoyed seeing that money moved from one place to another. Back to, well,
I would certainly, I think that would make sense, and and also just maybe rethinking our cash holding in the investment piece.
Okay. Do you have an idea of what number you think would be prudent?
You know, give them a range. Again, you don't want to tie them up, but 0 to 10% is kind of the range I've seen in nonprofit world.
Okay.
Yeah, I was thinking switching
Doing
to
a
a percentage
percentage.
range instead.
Yeah.
Range
right,
instead
so
of a hard
we
value.
roughly have 700,000 right now, so we're under that threshold, and
Yeah.
the language
Yeah.
would be perfect, right?
Right,
Is
but
there-
if they chose to draw that down,
Or draw it up, either way.
Yeah.
right, but I mean, again, we're dealing with local folks. If you see a cash need in a month, it's no big deal to call them up and say, at the end of the month, we're going to need X. And they have no trouble accommodating us, you know, again, if it exceeded our cash position, they could meet it.
And again, when it comes to the money side, the cash concerns are non-existent. Because of the money market account that we were discussing earlier, we've got $5.5 million sitting in the money market account. that can address any cash flow issues that we're ever gonna have. And that's primarily gonna be consisted of what would be considered the undesignated fund balance in the general fund. And the cash balance for the wealth managed fund that we've been discussing is, there, I think primarily for the ability of the management team to enter into holdings when advantageous, and then also on occasion when we need to liquidate to reimburse the general fund for expenses that have been paid on behalf of the reserve account.
So other than at the end, in June, when we're under some time pressure, I mean, they have plenty of time to accumulate extra cash to reimburse our operating account.
Sure, and I can, this can be done at any time, I mean, and they can be carried forever. For example, the Marina fund does not have its own bank account that's in the Marina fund. So the assets are held within the general fund with a corresponding liability due back to the Marina, and it goes up and down as the general fund pays for Marina expenses, but then collects money on behalf of the Marina. So essentially that's kind of what's happened with the reserve account, is that the receivable from on the general fund's books from the reserve account has just gone up as it's paid on behalf of the reserve account. And that's a pretty standard approach. It's just basic fund accounting and governmental.
Yes.
So for them, on the investment account, it's the parking lot. It allows them the flexibility to move us in and out of positions and without have to instantly buy more.
Right.
And so by giving them that, like what Brian's saying, the 0 to 10% range, it allows them to do their job and what we're paying for. And I would be good. I'd be very good with the 10%. I think that's, it's well under that now.
Right. But
Well,
rather than the fixed and 500K.
Correct. That's where I'm going. Give them some wiggle room.
Yeah.
Wouldn't 10% be 10% would be higher than the minimum 500,000 right now?
Right.
Yeah.
And again, I agree with Phil that this allows them to
Do their job.
liquidate. You get into this position where if they elect to liquidate, all of a sudden your cash holdings can be above your stated limit.
Well, I think isn't the language,
A minimum.
it's a minimum of 500,000.
So we could increase, we could be higher than that. Is what we're saying.
Right,
But
that's
I'm
why
saying
we
drop
currently have
the other end
700,000.
too.
Right.
Drop which end?
0 to 10 gives them, again, in a strong market, it allows them to fully.
Oh, I see. Give them a range of acceptable cash.
Right, not-
Between 0 and 10. Well, you wouldn't want 0, but between what, 2 and 10? something
2
like
and 10,
that. Okay.
Yeah, but it could go as low, it could be as low as 2 because we don't have the need for having that cash there. In order to
Correct.
use it, because we have the sweep account that is
Right.
taking care of those
Yep.
needs.
I mean, I see it as an avoidance that they sell something and they have to go buy something that same day. We don't
Right.
want them in that position. That's
Right.
how I see it.
But yeah,
Exactly.
it provides flexibility.
Correct.
Yeah.
What I would suggest is all these things that we've talked about, I've been keeping notes. I will work with them to come up with language that's acceptable. And then I would suggest we start meeting on a quarterly basis. And I think the mid-October meeting, I can come with the new quarter's investment performance and also proposed investment policy changes.
Sounds good.
And do we want to discuss the possible toe dip, because about an ESG, just something that we can physically track to say, look, we tried this, it either worked or it didn't work, or, we bet that we get the wrong thing at the right time.
Do you think it's worthwhile and possible to just do some benchmarking on previous, past?
We could definitely ask them to
and
track
see-
one of those Vanguard fund.
Just as a first step,
That's a good
to
idea.
direct them to do
Safer.
something like that, to just at least get a sense of what's.
We didn't lose any money, is what
Right.
we're
Yeah.
trying to say. We're doing.
Yeah,
we're
before
doing-
we start to
Right.
shift.
Right,
And then we think about what percentage we might want to shift based on what we're looking at there. And,
right.
if you're only shifting a percentage of your total portfolio, 25%, whatever it is, then in aggregate, that change, if there's a small decline,
Right.
if you go to an ESG, that small decline is washed out,
Correct.
but you're still at least
Making an effort.
making that effort. And yeah,
So I guess the question would be, how many times do you want to take an amended policy to the board? Because if we wait to determine that, you've got at least 2 potential times that an amended policy will come to the select.
Well, I
board.
think in the interim, we can get that before October. We could definitely look at that Vanguard. I mean, that's.
I would
public.
expect so.
Yeah,
Because I could have language ready to go and we could drop in a number at the October meeting when the rest of the language is reviewed. And if we decide, oh my gosh, that's a horrible investment, we can strike it all together.
correct.
That work?
Sure.
Did you both understand that?
Um,
And I got a stupid question to ask.
No stupid questions.
We are still subject to capital gains like any, with no capital, right? Because we're a municipality, we do not pay capital gains because
Right.
we could tax others. That's what I love.
So, yeah, so there's no tax consideration.
Correct.
When, like, if they have to sell something at a gain because we need the cash, has no effect.
Because again, because we're
Right.
nonprofit.
Right.
I knew that, but I wanted to clarify that. But I do like that we can tax others.
Is there anything we need to do about the cash analysis?
That was just because I had prepared it for, again, when I was reviewing the investment policy, I noticed the quarterly reporting requirements. And so I threw that together and it was going to be presented to the board in their consent agenda. And we were going to be meeting the Friday before, so I just threw it in there
Okay.
for your review.
No surprises there.
Mhm.
Okay,
So we'll meet in October.
I think the only thing was that we had already discussed, which is just that we've got, $5.5 million in the in that, well, or I guess it's $5.1 million in the wealth management money market account. And then we've also got, $8 million in the wealth management fund.
Right.
That's in a different side of the bank. And just that the money market is producing the same rates as the ICS account. And so calls into question whether or not we should continue that.
very good. I'll make a motion to recommend transfer of $2 million from the town's First National Bank money market account to the town's operating account to ensure adequate cash flow to be presented at, or the recommendations to the selectmen.
Seconded.
Any discussion? Any opposed? Done. Any other business at present? I think we've covered everything.
It'd be good that we meet quarterly.
Yeah.
It'd be good. Let's keep us all thinking about all this instead of showing up once a year.
Right.
See how well we did, because that's what it seemed like
I know.
years ago.
And we got it's a pile of money.
We're very lucky. There are like
Yeah.
I think we're one of the few municipalities with this kind of cushion.
Right.
And we thank the people that,
Mhm.
donated to the town and our, high tax base that, we're really, our valuation is amazing.
For sure.
And we still have to, and our other job is to make sure we, have the infrastructure and, and the quality personnel and do all the things that, because we have all this, we shouldn't skip on,
Right.
maintenance and, taking care of, building repairs and things like that and roads. And we got to make sure that aren't, that we're not just parking this money and not using it when it should be used. And again, looking at the future of, should we be rebuilding seawalls and things, that came up earlier, are there places in town that we need to start looking at to make sure we're invested in the future and won't be, have to use all this money someday because we didn't think about it today.
Right.
That's where I stand personally.
And I think the only caveat on that is that when you look at the bottom number of 19.5 million or whatever the cash holdings in total are, it feels like that's what we have to spend. And if you look at the 2021 audit, the undesignated fund balance is sitting at about $3.5 million as of that date.
Most of it is obligated in some form.
Correct. It's earmarked.
Right.
Yeah,
But we all-
at various levels, there's like 5 different assignment levels of fund balance, and undesignated is the only ones that have no sort of encumbrance at all. And so I think that's important to keep in mind, especially as you know, you have to think about it in terms of a percentage of the budget. So including assessments and everything, we've got what I think it's like a $22 million budget for fiscal year 23. So if we have a $3.5 million undesignated fund balance, that only covers a few months of that budget. Now, that's mitigated by the fact that there's tax revenue coming in and to account for it and everything. But it's not like we're definitely not sitting on an obscene amount of cash.
Right.
For the
What
size
about
of the
the
budget.
5 million in this money market?
And that's what I was referring to earlier, that at least a portion of that is going to be considered undesignated fund balance, and that's where it's ended up. I will say that when you're talking about numbers like this, it's not always easy to say exactly where every dollar is, but from a glance at how everything has operated and consisted, it seems like that's where excess has been parked over the years, and with the hopes of getting better returns than what we're getting out of the operating account. But as we discussed, it doesn't seem like we're really getting that, and so that's where the discussion comes in about redistributing the funds and maybe keeping things in the operating account if we're receiving the same funds. But it doesn't all have to go in there. You know, I think in the past, $2 million has traditionally been what's transferred to cover the kind of the cash flow concerns at the beginning of the year. And that means there's still about $3.5 million or $3.1 million in the money market account that never gets touched. And so the other side of this is that might be an example of money that could be reinvested somewhere else, not in a 0.3% return, but in something that we hope to see higher returns.
Something like,
Yes.
even park some of the money into this,
Correct.
but our policy has to dictate that we can do that.
Yeah, and that would, where that would be is in the cash analysis. The investments that we've been talking about are consistent of general fund investments, reserve investments, and marine reserve investments. And so if you didn't have it tied to any reserve obligations, it would increase that, I think, $1.9 million reserve investment line item. Or not reserve, but general fund investment.
Yeah. I mean, again, but with an $8 million portfolio, I mean, we do have to be conscious of, you know, 0.5% difference in return is a pretty significant number.
Mhm.
And that's where our fiduciary responsibility kind of comes in.
Mhm. I agree.
Okay. Any other business?
Can you hear me?
Yes.
I would just like to say, like, for select board and that Jake has just been great. And I think the reports are so helpful. And so just so you guys know, as a board, I think we're really happy. I think we get what we need from him and trust his recommendations. And so I just wanted to pass that along, that I feel like we're in a really great, and Kathy was wonderful. But I'm just saying, Jake, it's just been a great transition. And I think we're very lucky.
Thank you.
Excellent. Nothing further. I'll make a motion. We adjourn.
Second.
Any opposed?
No opposed. And you both will pick a date in October.
Yeah, I would say, how does Fridays work?
I'd love Friday. I was hoping you were gonna, we're just
Fridays
gonna
are
pick.
great.
How about third Friday of the month?
Perfect.
That gives me time to prepare reports and everything.
Right.
So, yeah,
Because typically the first doesn't get their performance reports out till the middle of the month.
right. And I do have some operational things that I have to accomplish too. So sometimes it's hard to find the time to do this kind of work. But I think third Fridays as an ongoing basis may be a good idea on a quarterly basis after and set it up starting in October so that we're getting quarterly reports to review. Okay.
And we definitely want them to come in.
Every single time?
That was a question. Once a year, I'm good with once a year or as needed.
I think their reports are
I
good.
think they're good too.
I know they think it's customer service, but if we're working on an investment policy review, I don't think
We don't want them here.
we don't
Sorry.
need to
Right.
take the time to listen to the spiel. We can look at the report, pretty self-explanatory,
So just as needed or
as needed once a year.
once a year.
And then what I'm thinking is that the way that the investment policy reads is we invest, or I need to be reporting quarterly, you guys review that, and then I need to be reporting those to the board. So I'll bring the reports to the board after our meetings quarterly. So they'll see them about a month after the information is.
So having these guys come in just before, before this time, in June every year is probably just before we start the new fiscal is the best probably time to have them come in, because we have really the full fiscal year to look at, even though everything they do is based on calendar year.
Right.
It was a good meeting.
Good meeting. I hope we own some Dell stock.
Wait, you all got Dell computers?
I can look through the S&P 500.
We call Michael.
holdings and
Let's
see.
do Michael Smith.
Are they, I don't think they're public. Michael Dell took them private.
Oh, they did?
They went back the other way.
Oh, okay.
When I was living in Austin and working there, I was there for 5 years, they were just referred to as Dellionaires, the people that sort of were at Dell and then now they're not, because they went private and they just.
I went ASUS for the work computer. I hate it. I mean, I thought I just didn't buy as good of one as I probably could, so I'm spending somebody else's money, but I think I'm gonna go, I don't know, I like my MacBook Pro. I think I'm gonna go Apple the next time.
Yeah, my wife and son are Apple people. I should be because I have an iPhone, but I can't quite bring myself to double the price of my work computer.
It's the processor is a lot, that's what I noticed is the processor is really faster, and I find that very sticky, but anyhow, everything's keeps getting faster, and
Right.
that's how it is. I had to do it because I used to do I used to use FedEx Ship Manager, and you had to do it in PC.
Right.
It's all the same thing. It's like, and all navigational software was always in PC based too,
Right.
because they wanted to cross the board, all bridge, glass bridge, and everything had to always be one system, there's language barriers and things like that.
Everything's in the cloud now.
It's up there.
So it doesn't matter whether you have a PC or.
It really doesn't. It's all over. I did half the thing on my phone here today.
Right. That's what amazes me.
If you told me 10 years ago, well, I had the original iPhone, but if you told me 50 years ago, I'd have a computer in my pocket, plus all the navigational software and any ski trail map I wanted or anything, it's just amazing.
Now my son has it on his watch.
Can't do that. I tried. It just doesn't work for me. I put it on riding a bike because it has the phone. Elsewise, I don't want that text going off. I still run analog.
Well, he's a trail runner and he didn't want to carry his phone anymore. So he got the new Garmin that has a cell signal in it. So
Oh, wow.
Right.
That's cool.
he doesn't have to carry his phone. But we know
We
where
could track, but we could
we
track.
can
it.
watch where he is. Well,
All right.
Goodbye, Derlin. Goodbye,
Bye,
Wendy.
How are you feeling, Derlin?
Hey, Kyle, it's been a decent week.
Yeah, town's still running.
Yeah, all right, well, hopefully. Hopefully
You
I'll
feeling
see-
better?
Hopefully I'll see you Tuesday.
So you are feeling better? I think it's what the group wants to ask you.
Oh, the fatigue is the only symptom I've still got. The rest, the sore throat, the chills, the fever,
Oh,
all that stuff's gone, but the fatigue is gonna take a while, I think.
well, give yourself time to heal, please.
But it will, it's just a matter of time. So, but other than that, thank you for asking.
I appreciated Jake being able to come over quickly to the school and kind of chat about how
Yeah, I
to
can-
move forward on that. That was great. I'm glad he was able to step in.
Yeah, that fell right off my radar. Once I got that COVID diagnosis and quarantine, that was kind of, my apologies for missing that.
No problem. We were in good hands. It worked out just fine.
Great, glad to
And he'll
hear.
catch you up.
Yes.
On our discussion.
Sure, absolutely.
Are we done?
we're done. Thank you.
All right. See you, Derlin.
See you, Derlin.